Welcome back to another video. In this video, we're going to talk about chapters 13 and 14, money, banking, and monetary policy. In the previous video, we talked about fiscal policy. And in fiscal policy, that is, there are two tools in the toolkit for the federal government when it comes to influencing and instigating changes in the economy. Those are taxes and spending. A contractionary fiscal policy is increasing taxes and decreasing government spending, and an expansionary fiscal policy is increasing spending and decreasing taxes. Those both will help move the economy along into the right direction as we approach or try to get back to what's considered by Milton Friedman natural rate of unemployment, or about 5%. That is an arguable position. We should have everybody working and everybody should be employed, but there are naturally, because of choices people make, they choose to want a better job, but until they find a better job, they are out of work, or they do not have the skills to get that other job, and so they are out of work until they get the skills or find a match to those skills they have with a job that needs those skills. Now, fiscal policy is one thing, and that's handled by Congress. Congress has the right given to them by the Constitution to collect taxes, spend money, and wage war. We're not going to talk about waging war right now. We're going to talk about just the fiscal policy and how it helps with the economy. In these two chapters, and in this video, we're going to talk about monetary policy and money and banking, because that is a separate entity from the government. The Federal Reserve is an agency that is set up by the government but is independent of the U.S. government. That is unlike other countries whose central bank is part of the government. In the U.S., the Federal Reserve was created to be independent of the government and monitors and makes decisions of monetary policy independent of fiscal policy and independent of Congress. Now, the chair of the Federal Reserve may attend a congressional hearing as to the status or state of the of the economy and what their plans are, but they make their decisions independent again of Congress. So Congress just needs to know what's going on as a report, but the chair could also say, I'm not coming, and they can't do anything about it. But it does behoove the Federal Reserve and Congress to work together. In fact, the Federal Reserve does work well with the Treasury, which is a cabinet position of the federal government, appointed by the President and approved by Congress to become the treasurer of the country, and monitoring spending of the federal government as well as Congress. Congress approves the spending, the treasurer makes sure that the money's there to spend it. Congress approves taxes, and the treasurer is in charge of collecting the taxes. Federal Reserve handles money and the banks. Now, what is money? Recall from our chapter 1 and 2 video, I mentioned the 5 factors of production. There are, in no particular order, natural resources, land, water, labor, physical capital, human capital, and entrepreneurship, the 5. I have 5 because I have 5 fingers. Now, notice that I didn't mention anything about money. Money is not a factor of production. You cannot take money and make anything out of money. You can take wood, go in the forest, cut down a tree, and make something out of the wood. Or the wood could be used to build a fire that could heat a furnace that you can melt iron ore to make something out of metal, or water can be used to make something. That's a factor. We, as labor, make things. We also, with our human capital and our skills and education, also facilitate production. We need machines, but those are the factors of making things and producing services that runs the economy and builds our GDP. But money is not. Money is merely a means to the end. So money actually has three functions that we talk about. One, it's a store of value. A dollar is a dollar, and it has a value that we all accept. As I said before, a dollar is a dollar, and we know that we could take that dollar and use it to buy things. And so it has a value to it. And so that's why we crave money, but money does not make the economy run. It's the production, and money is used to help that. And it is also a means of exchange. It's a unit of exchange. It facilitates exchange. Long ago, before we had currency, we used to trade and barter. Bartering is taking a good from one person and exchanging it for a good from another person. We found that people were bartering more, and people do barter, especially when cash is tight. We would do services for services or barter goods for services. I'll give you 3 goats if you mow my lawn, or paint my house for some eggs, and I'll give you some eggs from my hen house, and you can paint my house. Things like that. That's a form of bartering. The problem with bartering, that's what came up, is that we need to find someone. If you have something you want to give up, remember voluntary exchange, one of those 10 tenets, voluntary exchange, not David Tennant, 10 tenets, is that we are willing to give up something in exchange for something that makes both parties better off. So we find someone else that we're going to exchange something for, and they are willing to give up something we want. That's the crux of bartering. But it's also the crux of the problem with bartering, in that you must find someone who's willing to give up something you want, and you're willing to take what you want to give up in exchange. That's called the dual coincidence of want, where you have 2 individuals coming together who are willing to coincidentally give up what the other person wants. And if that's the case, then you have a trade, and bartering happens. But when you cannot find someone who wants what you want to give up and is willing to give you what you want, then there has to be some other way to facilitate this trade. And that's where currency and money comes in. Money is a unit where we all can accept that value. And we may have our own individual values to that money, but nonetheless, we can all agree that a dollar is a dollar. Whether the dollar is worth more to you than it is to me, there's still a value to that dollar. It's not worthless. Yet, anyway. So in that case, we can take that dollar and say, I'm willing to spend $10 for an item you're willing to give up, instead of giving you my pen for what you want to give up. I'm offering a pen. Do you want it? No? Oh, well, then I cannot. There's no dual coincidence of want. Barter does not happen. Trade does not happen. But if I say I'll give you $10 for what you're willing to give up, if you feel that $10, the value of the $10 is worth enough to give up what you're willing to give up, then I'll give you the 10. And what you can do now with that $10 is buy something else. You do not have to find someone else who's willing to take it, you can find many different people are willing to take the $10. It facilitates this trade between people. We do not need that dual coincidence of want because everybody wants the dollar. Now, the third function of money is that it is a unit of account. When you go to the store does not price things in eggs or goats or cars. It's listed in money. You go to the store and pay $1 for a bag of chips, or $1 for a bottle of pop, or $10 for some meat, raw meat, or $10,000 for a car. These are all listed in money, and so it's a unit of account. Also, when we do accounting, remember that human capital of an accountant, they register and record revenue and expenses and assets, liabilities, and equity, all those accounting functions with money. And that's how we do it. We record the GDP in money. Nominal GDP recorded in money. Inflation is a change in prices. Prices listed in money. So the change in those prices is a percent and it's a rate, but that's listed in money. We are paid in money for our services. When we go to work, we get paid in money. Now, how do we measure money? What is the measurement of money? How much money is there in the country? That is what we're going to show you right here. You see, there are two circles here. There's a small circle in the center and a bigger circle around. We call that small circle in the center is called M1. M for money. So money 1. Actually, I have an even smaller circle that I talk about in the center of that small circle that I call M0. That's cash. That's the most liquid of money. It's the most easily spent is cash. If we had too much cash, we always spend it too much. And that's what is a smaller circle. But the circle here, this center circle, is M1. M1 counts currency, cash, checking accounts. Also, traveler's checks, but who knows what a traveler's check is? If you're old enough to know it, good for you. But we don't do traveler's checks anymore. So you can always use some other form of currency or ways of buying things internationally. We don't talk about traveler's checks, but if you read in a textbook, it may mention that. Forget about that. Really, substantively, it is currency and checking accounts in banks. Bank deposits, specifically in checking accounts. Now, the larger circle around here is what we call M2. M2 is M1, so everything in the small circle, that's why it's inside, plus savings accounts and short-term time deposits, which is the technical term for a CD. A CD for less than a year. A 3-month CD, a 6-month CD, a 9-month CD, 12-month CD, something that's small, but it's small in time, not small in amount, but small in time. Technically, and by law, a savings account, your access to a savings account is limited versus a checking account where you can write a check and you always have access to it. You can write a check for cash and cash a check and you get cash right out of your checking account. You can go to the ATM and get money out. With a savings account, though, it's limited to a certain number per month of transactions. With a time deposit, like a CD, you're only limited to, you can withdraw it in the middle of the term, but you lose your interest and maybe some penalties, or you could wait till the end and access your money at the end of that term. At the end of the 3-month CD, you get your money back, plus the interest that you earned. So we count both M1 and M2 because that is the flow of money between spending money in part of consumption, part of the money we earn less taxes, our disposable income, some of it we save, and that goes into the savings accounts. So it goes into the larger section of this. And some of that money goes in our checking account, which we spend, and that's in the smaller one. So we count both. That is really the amount of money that money, not cash, but money that is flowing in an economy. And so we count both. Now, I have a savings account with a credit union, actually, and I have a checking account with a bank. So what if I write a check and deposit that check in my savings account? What has happened? What has happened in this whole circle? Well, because I wrote a check and took money out of M1, M1 shrinks by the amount of the check. But I put it into my savings account, what happens to M2? No, it doesn't get bigger. It stays the same because all I did was take money out of M1 and put it in M2. So it went from the center, the smaller circle, into the larger circle area, but it didn't go outside and make it bigger. It just went inside. The smaller circle shrinks a little bit, and then the bigger circle stays the same. All we did was move it back and forth. And that's the flow of money between savings and checking, or cash. You can take your cash and deposit in the savings, or you can withdraw limited, but you can withdraw from the savings and put into the checking. If I took money out of my savings, reverse this, and put it in my checking, what happens is the center circle gets bigger, but the outside circle does not change because we didn't add any more cash into the system. I just moved it from one circle to the other. So understand that movement between the circle only changes the size of the smaller circle, but not the bigger one. So M1 plus M2, M1 is part of M2, so M2 is considered our money supply. And that is what we count as money supply. It is the cash that we have available to us. Now, in this money supply, that money supply actually can grow, but it grows not because of the movement in between. It's putting money into that system. How do we get money into this is what the Federal Reserve helps us. And we'll get to that in a little bit. So how does that money supply grow? Now, let's talk about money demand and money supply. Now that I've alluded to the supply of money. The only reason we demand money is because we want to buy things or services. So we have a demand for money, we take the money and we buy stuff. If we need to buy more stuff, if we want to buy more stuff, we're going to demand more money. So this is a money demand, money supply curve. Let's take this Federal Reserve out of it for just a moment. Just look at M2, which is the supply of money. So it looks just like the supply and demand curves we've looked at before. Here is the demand for money, and here is the supply of money. And quantity of money is listed here on the horizontal axis, the x-axis. But what is displayed on the y-axis? Well, the y-axis, as we've seen in the supply and demand curves, is the price. Well, what is the price of money? You don't go to the store and say, I want to purchase money. Where do you go and get money? Go to the bank. So going to the bank to get money, you can take it out of the bank account, whether it's checking or savings. You can take your cash out of that. But what if you don't have enough cash in the bank? What do you do then? How are you going to get money? You borrow the money. So when you borrow money from a bank, you're charged interest. So interest is the price or the cost of borrowing money. The higher the interest rate, the lower the borrowing. So when you see the price, which is the interest rate, going up, notice that the demand, quantity demanded for money, goes down. The higher the interest rate, the lower the quantity demanded. So we demand less money because it costs so much. As interest rates go down, we'll borrow more. Now, conversely to the borrowing side, there is the investment side or the saving side. We put money in the bank. Why would we put money in the bank, especially a savings account or a CD? The interest. Not just to save, but we would want to grow that money, so we want interest. So when we put money into the bank, in the banking system, into M2, when we put money in M2, or if we add money to the system, as we're saving, the reason why we'll save more than we spend is because of higher interest rates. And so that is the supply of money. Remember, M2 is the supply of money. How does that grow? How does that work? Well, the supply, if interest rates are low, then we're going to supply less money. The higher the interest rate, the more we're willing to put into savings than spending. So our marginal propensity to consume versus marginal propensity to save, which is equal to 1, MPC plus MPS equals 1. That's a percent of our dollar that we get, the disposable income. How much are we going to spend on consumption into the GDP and buying finished goods and services? And how much are we going to put into our savings and add to the money supply? Incorporate that into the money supply. So our supply is determined and our savings rate is determined based on the interest rate. The higher the interest rate, the more we'll save. And that's actually, economists use the word invest. So we're investing into the economy, into the money supply. By moving money from our pocket into the savings and into the bank, we're raising that money supply. And only reason why is because interest rates are higher. So higher interest rates mean that. Well, now that I say that banks are a way of saving, but that's not the only way we can save. We can buy bonds. And we can get involved in the loanable funds market. That's part of bonds. Bond is a loan that businesses borrow money. Businesses sell a bond, we buy that bond, and in exchange we give cash to that business. And that business promises to pay us that money back plus interest. We can have treasury bonds, which is the U.S. government borrowing money from people. And we'll talk about national debt and that borrowing a little bit later. But how do we fund these fiscal policies of spending? Is to borrow the money. The government borrows money by selling these bonds. The bonds we buy, we give the money to the Federal Reserve, or excuse me, to the government. The government uses that to spend. And that is part of that investing. We can also invest in the stock market. The stock market actually is a measure of value of capital in the marketplace. So those stocks that we're buying represents a portion of capital that businesses are using to produce. And it's the value of that capital that they're using. So IBM and the computers that they make, and you look at the stock price of IBM, and it's basically the value of all the capital, the physical capital that IBM is using to make computers. For instance, or Ford. You look at Ford or GM's stock price, and you look at the price there, and that is equivalent to the value of its capital in making cars. So that's another type of investing. So we have three markets that we are investing in. So I'm making now a distinction in the money market. We can invest in the money market by putting money in the bank directly. We can invest in the bond market, which is part of the loanable funds market, and we can invest in the stock market. That's us putting money in, and when we take our cash and put it out, we get in return a piece of paper equivalent to that money. And that's part of this savings. So money market is what we're focusing here. but it's similar to the loanable funds market. Similar, because it incorporates that additional market of bonds and stocks. What if the money supply goes up? That means that there's a positive shift in the money supply. So if the money supply increases, what happens to, and the demand doesn't change, what happens to the price? What is happening to interest rates if money supply increases? Well, the money supply increases, the price goes down, you see? So equilibrium has changed, the equilibrium quantity and price. So equilibrium quantity goes up. If the interest rates are going down, we're going to borrow more money. When we borrow money, and so, but at the same time, we're going to take money out of our savings because our savings is not earning as much. So if the interest rates go down, two things are going to happen. People are going to borrow more money because it's cheaper to borrow, and then they're going to spend that money. So consumption goes up. But at the same time, consumption is going to go up because we're taking money out of savings because of interest rates going down. So both pieces happen at the same time, concurrently, not for the exact same time, but concurrently to increase consumption. We'll save less because interest rates are less, and we're not getting as much in interest because of it, so we're going to spend that money instead of saving it. And two, we can borrow money to spend. So both those combined increases consumption. So we will consume more. And because we consume more, GDP goes up. Now, how can we increase, how else can this money supply increase? Well, this is a slightly different curve, or money supply, but incorporates now, let's add in the Federal Reserve. The Federal Reserve can also manipulate this money supply. As I said before in my concentric circles of M1 and M2, the money between those two does not change. Yes, M1 may shrink if we put more in savings, or M1 may increase if we take money out of savings, but M2 doesn't change. How do we change it? We change it by the Federal Reserve actually increasing it. Now, I'll explain a little bit how the Federal Reserve increases this money supply. But when we throw in the Federal Reserve into this market, again, it's not the government, but we incorporate this money supply, the Federal Reserve Agency, we now have actually a vertical supply curve. It's vertical because the supply is ever increasing. So it's so large now because of the manipulation, we're going to keep it as a fixed amount. So the quantity is fixed at one point, but the demand doesn't change. So notice that the demand has not changed. So we do the same manipulation, but now the Federal Reserve is going to get involved and increase the money supply. It does the same thing as we saw before when we didn't have the Federal Reserve, but once we throw the Federal Reserve in there and all the banking, we have a vertical line. That's just because the size of the money supply. A further explanation can be made in a much larger, bigger class or a later class in macroeconomics. Suffice it to say that at this level, that this vertical line is represented because of the involvement in the Federal Reserve. If the Federal Reserve increases the money supply, then this line will all still shift in a positive direction, and it does the same thing. It pushes the interest rates down, more borrowing, because the quantity demanded of money will increase. Even though I said before that the quantity supplied goes down as interest rates go down, the Federal Reserve will put more money in to maintain that level. That's why it's vertical. So the level on the size will not change. In fact, it will get bigger because the Federal Reserve is trying to maintain the level of cash and of money in the system. By increasing the money supply, it's not because we all earned more money, it's because the Federal Reserve is flooding more cash into the system. And by flooding more cash into the system, it increases and decreases the interest rates. And that's what currently is happening now, and it happened in 2007 when the Federal Reserve started dropping interest rates. One thing it can do is manipulate interest rates. I'll get back to their tools in a minute. So understand this mechanism, because it's going to come back again when we're in hitting 18 and 19 when we talk about the exchange rate. In international trade, we have to talk about the exchange rate and the foreign exchange market. Remember back to my circular flow of the economy. And in the circular flow of the economy, I said that the international trade with the rest of the world is another market. So that described 4 different markets, distinct markets: the products market, the products market, which is all finished goods and services, the factors market, which is labor, capital, the international or foreign exchange market, and then the loanable funds or money market. And we're talking about the money market here in this chapter, part of it. I'm sorry, that's what we're going to touch on. So by increasing the money supply, interest rates go down, more borrowing happens, not just from us, but businesses borrow more money. By businesses borrowing more money, they're going to invest. And by investing, they're going to buy more capital and increase production. And that's how they're going to grow. If they grow, they make more stuff, there's more finished goods and services available and for us to buy. Prices go down because there's more stuff to buy. So the GDP grows, the economy grows. The other side is, of course, that there could be a contraction in the money supply. And the money supply goes down, interest rates go up, there'll be less borrowing, quantity demanded of money goes down, and we spend less. If we spend less, then that's going to be a contraction to the GDP. Now, let's talk a little bit about the Federal Reserve System a little bit. I don't want to get into the Federal Reserve too much. As far as the organization, there are 12 Federal Reserve branches around the country. Ours is in Chicago, for Michigan. There's one in Cleveland, Atlanta, San Francisco, I believe. Denver is one. There's 12 around the country. And each of these branches, it's not like an individual branch. They've got branches and sub-branches. There used to be a Federal Reserve and a branch of Federal Reserve in Detroit. They closed that down many, many years ago. Over 20 years ago was when it was closed down, so they don't need it anymore. So we still have the major branches in Chicago and Cleveland. These 12 branches or regions are headed by a governor. So there's a regional Federal Reserve governor in charge of each of the regions. And all 12 answer to a chair. And this chairperson is the head of the Federal Reserve. Currently, as at the time of this recording, it is Jerome Powell, or Jerry Powell. Jerome Powell is the current head of the Federal Reserve. Previous to him was Janet Yellen. Janet Yellen, who is currently, at this time of this recording, is the treasurer of the United States. So, bit of trivia, Janet Yellen was the head of the Federal Economic Council. She was also became head of the Federal Reserve as chair of the Federal Reserve. And after leaving the Federal Reserve and training Jerry Powell, by the way, to be the next chair, she now is the treasurer of the United States, the first woman to hold all 3 positions in the history of the United States. And these are the 3 top economic positions in the country. The Economic Council monitors the economic data. That's one major thing they do. The Federal Reserve handles monetary policy, and the Treasurer works with fiscal policy. So she's been in charge of many of aspects of the macroeconomics of the United States in her time. That's not the only thing she's done. She's also been a professor at Harvard, and that's where she met her husband, who is also a Nobel-winning economist. Akerlof is his name. Yellen kept her maiden name, so she's known as Janet Yellen, and he is Akerlof, Professor Akerlof, an author as well as a professor of economics. Little sidebar there on the history, most current history, little trivia on the Federal Reserve. Interesting, I think. That's why I have a great deal of faith personally in the monetary policy that's going to happen. Jerry Powell in March was part of a conference that he spoke of in regards to the state of the economy and what the Federal Reserve plans are for the future of growth, and basically said he was going to continue with the policies that are currently in place until full or closer to full employment. He used the phrase full employment versus natural rate of employment because he's not a Milton Friedman fan. Neither am I. But that's beside the point necessarily. So the Federal Reserve is also what I call the bank's bank. It's the bank's bank. When a bank wants to, with Comerica or Chemical Bank, Huntington Bank, Citibank, if they wanted to borrow, if the bank wants to borrow money, they're not going to come to you and say, hey, give me some money, I'll give you interest on it. Yeah, they do it on a CD, but they're not really coming after you. If a bank really needs large sums of money, they don't go to the people, they go to the Federal Reserve to borrow money. And the Federal Reserve lends money to banks. If it needs some capital, if it needs to raise its reserves, and that is called the discount rate. If the bank actually wants, if Citibank goes to Huntington and say, hey, I need a little scratch, can you loan me some money? Huntington says yes, but we're going to charge you what's called the federal funds rate for short-term borrowing. Those are two rates that the Federal Reserve has a bit of influence, specifically the discount rate and the federal funds rate. So those are your base cost of funds for a bank. So banks also save money. Their reserves, that's called a reserve. The bank's savings is called a reserve. It's not physically in their bank, it's on the books. And that money, which is called the reserves, is held at the Federal Reserve Bank, because it is a bank, but it's not a bank necessarily that you can walk in and say, hey, I want some money. You don't have an account. The banks have accounts with the Federal Reserve. It is actually in the Federal Reserve what's called Main Street lending. Not Wall Street, Main Street. It does have a program as being the lender of last resort. If you can't get a loan from the bank, you can apply for a loan from the Federal Reserve. But the Federal Reserve is actually dealing with large sums of money, not a couple of $1,000s. But in extreme cases, it is the U.S. lender of last resort if you can't get through the bank. It was used very recently in 2008, but it's been a policy all the way through. It's just never been enacted until very recently. Within, again, the last 20 years or so, less than 20 years, it was a policy that really came to fore when the banks stopped lending money. In 2008, 9, and 10, during the Great Recession, banks weren't lending, so there was no other choice. People had to go the Main Street Lending Program, is I believe what it's called. That is a program, but it is really the Federal Reserve exists because it is the bank's bank. The banks borrow, the banks also save money in the Federal Reserve. It's called reserves, bank reserves. Each bank has an account. And the Federal Reserve also is the what's called the clearinghouse for checking accounts. If I write a check from my checking account at TCF Bank, and I write a check to you, and let's say that you have a bank account with Comerica, and you take that check and deposit it into your bank account in Comerica, what happens is Comerica sends that check electronically. In the olden days, they used to take that check, and the check would go from the bank to the Federal Reserve, and what the Federal Reserve would do with that check is, at first, Comerica is going to credit your account for that money. The check goes to the Federal Reserve. The Federal Reserve credits Comerica's bank account reserves for that check and takes the money out of TCF's bank account with the Federal Reserve, and then the check comes back to TCF, and TCF takes the money out of my account, and that's how I pay that check, and that's how it clears. And it used to take a week or more in the olden days before the policy called Check 21 went into effect. That Check 21 law went into effect, meaning that the banks no longer need to send a physical copy of that check to the Federal Reserve. They send an electronic copy. So they scan all the checks that we write, and it goes through the Federal Reserve and credits and debits the accounts, and then immediately the receiving bank the next day gets their money and gets that total of checks that cleared. And that's how it gets cleared now. So it clears faster. It takes a couple of days versus a week plus to clear a check. So another function of the Federal Reserve is a clearinghouse of checks. So it's the bank's bank, where the bank borrows money, like we do from the bank, where banks also save money on deposit money to the Federal Reserve, and it also is the clearinghouse for checks. You may hear the phrase ACH, Automated Clearinghouse, is what that ACH stands for. Automated Clearinghouse means it's the electronic way of clearing the checks, and that is more prominent now. You ACH, you don't actually pay checks anymore. Nowadays, I hardly write a check. I barely write checks anymore. I do everything, and that's using the ACH, or Automated Clearinghouse, to pay bills. I send a amount of money to my bills, my credit card, my loans, and it clears through my bank and to the receiving credit card / bank or vendor. If I'm paying my light and gas, they get an ACH. My credit cards, they get an ACH. My insurance, send an ACH out of my bank to the vendor, to my vendors, to my bills. Rarely do I write a check. So that's the same process, but a lot faster because it's all electronic. ACH, Automated Clearinghouse. EFT, you may hear that phrase, that EFT is electronic funds transfer. That's a broader term, meaning EFT is really the broader term. ACH is the technical or banking term for it. You may hear the phrase ASH or OSH. I don't like that. I like to say the words. I say the letters, ACH. I don't like OSH, but you may hear bankers saying OSH. I'm going to OSH that, or I'm ASHing that. That's the phrase ACH. I would say ACH. But I say it so fast, ACH, it sounds almost like a word. ACH, Automated Clearinghouse. Now let's talk about what the Federal Reserve can do in terms of monetary policy. What can the bank do in terms of monetary policy? Well, as I said before in this video, and I've said before in the previous video, the federal government has two tools in its toolkit: taxes and spending. With the Federal Reserve, it has three tools in its toolkit. It can adjust interest rates. it can change the required reserve ratio, and it can do an open market operation. But what does those three mean? Well, I've alluded to the first. Indirectly, the Federal Reserve can directly and unanimously, unilaterally decide what the discount rate will be and have influence on what the federal funds rate will be. So those, again, is the cost of funds for a bank when they borrow money from the Federal Reserve or from each other. That's how much they have to pay. So bank interest rates will be based, market interest rates will be based on that borrowed money. So if it costs 2% for the Federal Reserve, for Huntington to borrow money from the Federal Reserve, then they're going to use 2% as the base and charge above that on the interest. So let's pretend they want a margin of 2%. They're going to charge 4% for a loan and pay maybe 3% in interest or less. So if you borrow money from Huntington, you're going to have to pay 4% because their cost of funds is 2%. If the Federal Reserve raises that interest rate unilaterally to 3%, now the interest rate that Huntington is going to charge for that loan, instead of 4%, is now 5% because they still want to maintain that 2% margin. Now interest rates have gone up. That's borrowing. So that's how they manipulate the interest rates the Federal Reserve has. For the last 10 years, it has been, well, I shouldn't say last 10 years. In the last year or so, since the beginning of 2020, the Federal Reserve has kept the discount rate as close to zero as possible. It's called the zero lower bound. There is no way that in the United States that the interest rates that the Federal Reserve is going to charge is going to go lower than zero. Now that's untrue in other countries. In countries in Europe and in Japan had done this too, is that they'd had negative interest rates. So instead of you borrow money and they pay you to borrow the money. You don't pay the bank pays you to borrow the money. That's negative interest rates. Or you pay the bank to put money in the bank. You see, why would you put money in the bank if you're earning less than if it's in your pocket? That's ridiculous. So there's no money going into the banks from our pockets. It's coming from the central banks and the government. U.S. does not have a negative interest rates. We have a zero bound. So the lower zero bound or the zero lower bound is as low as it gets. It's between 0 and 0.25%. 0.25%. For every $100, the bank for every $100 borrowed from the Federal Reserve, the banks have to pay a quarter. Not a quarter of 100, 0.25 cents for every $100. That is what that means. If it's very low interest rates for the borrower, then it's going to be, for the bank, it's going to be low interest rates for the borrower. If we talk about that same Huntington Bank 2 points over discount, then they're going to charge 2.25% for you to borrow money, which is why we still have low interest rates that we've seen in the last 10 years or so. We haven't seen a huge uptick in interest rates because the Federal Reserve has kept interest rates pretty low. There was a point in 2015 or 16 when Janet Yellen tried to push the interest rates higher, but that there was a huge resistance to it in the marketplace and had to bring it back down. Now, the second one I said was required reserve. The Federal Reserve mandates that banks have to maintain a certain amount of cash in the bank. I call it a vault limit. It's an old term because there's no vault anymore. There's no real cash in the bank necessarily. The cash is not really there. But for every dollar that the Federal Reserve that a bank receives, it must hold a percentage of that in the bank itself. And currently it's 10%. The required reserve currently is 10%. So that means for every $10 that the bank has in deposits, it must hold $1. What is it going to do with the other excess reserves? The required reserve is the 10%, so what are they going to do with another 90%? They can loan that money out. And they can generate, so that money is available, and that's what's part of that money supply I showed you before, that 90%. So let's pretend that the required reserve is 20%. That means that a bank has to keep 80%, or must keep 20% of the money in deposits on hand in the bank itself, on reserve with the Federal Reserve, but excess of that, the excess reserves, is the 80% that they're able to lend out in loans. That's called excess reserve. If the Federal Reserve decides to lower the required reserve ratio from 20% to 10%, now instead of 80%, that's 90% of the deposits can be lent out. That means that we've increased the money supply that much more. So we have more money that's available to borrow, so that increases the money supply. If the money supply increases, interest rates go down too. So the Federal Reserve can unilaterally reduce interest rates by saying the rate is now 0.25 from 1% or from 3% or whatever. We're going to drop it down to 0.25%. It also can say, banks, you don't need to have so much money in your bank. You don't have to have as much reserves. So we're going to reduce the required reserve, and they now have more excess reserves to lend out. More reserves, more money available, interest rates go down, we borrow more. We spend more, GDP goes up. Open market operations is a function of the Federal Reserve where the Federal Reserve buys and sells government bonds. Now, the Federal Reserve is not the government. So the Federal Reserve gets bonds from the government directly that the Treasury sells. So Treasury sells bonds to get funds into the Treasury, cash into the Treasury for it to do its government spending, to fund the government spending that the fiscal policy is enacted. Congress doesn't spend the money. The Treasury spends the money. Congress doesn't collect the taxes. Treasury collects the taxes. Remember that. Fiscal policy is enacted, decided by Congress, and acted or executed by the Treasury. All right? So legislation, the law of tax, the law of spending is done in Congress. The executive branch, which is Treasury, executes that. It collects the taxes. It also spends the money. So it has to have the cash to fund the spending that Congress has said. We're going to spend more money, Treasury do it. Boom. Treasurer does it. So the Treasurer sells bonds to generate this money. It sells bonds to the Federal Reserve as an independent, non-government entity to get money from the Federal Reserve. So the Federal Reserve buys those bonds and sells, gives cash to the Treasury Department. Treasury Department has that money to spend what the fiscal policy dictated. The Federal Reserve now has these bonds, and it could do an open market sale of bonds, or it could do an open market purchase. Now, an open market is not with the Treasury Department, it's with the rest of the country. It's with that bond market I mentioned. So people who want to invest, and remember, the definition of investment in economics is different than in finance. In economics, we define it as people who are saving money. That's called investment. So individuals, consumers, investing money versus spending money is basically saving. How can we save? We can save by putting it in the bank. We can save by buying bonds. So the Federal Reserve sells a bond, and it gets cash for that bond. That cash goes into the Federal Reserve, and you're sitting with a bond, a piece of paper saying you bought that bond. that bond gives you the right to a certain amount of interest from the federal government, from the Treasury, not from the Federal Reserve. They're just a middle person. Now, the Federal Reserve has taken money from you. That's less money in your pocket. You have less cash in your pocket. What are you going to do? You're going to spend less money because you don't have as much money. You have this piece of paper. You can't spend this piece of paper. When you want groceries, you have to go in your pocket. You have less cash in your pocket. Now your spending is going down. Consumption goes down because you've used the money in savings. You've taken your disposable income, and instead of consuming with it, you took some of that money and increased your savings. So your portion that you saved has gone up, and in part of that savings, you've bought a bond with it. That takes money out of the system. So that's a way of reducing the money supply. So when there's an open market sale, that's from the perspective of the Federal Reserve selling a bond and taking money out of the money supply. That's going to reduce the money supply, and interest rates will go up, which will also reduce our borrowing. Interest rates going up means that it's going to encourage more savings, though. So if we see more money with interest rates in the bank going up for savings, we're going to save more. That's going to reduce our consumption even more. We buy the bond and we save more because we get more benefit. The cost of spending versus the cost of not spending versus the benefit of saving. That's the cost-benefit analysis there. We do that analysis and we say, oh, it's better for me. I get a better benefit saving the money. I get a better benefit buying the bond. Interest rates going up. An open market purchase is where the Federal Reserve buys the bond from us. So they go into the marketplace and say, hey, I'll give you some money, give me that bond. You get money, you exchange it for the bond. The Federal Reserve now holds that bond, and you have extra cash. Now you have extra cash. That now has increased your money supply, and further, that has increased the nation's money supply. Money supply increases. That's a positive shift in the money supply. Interest rates go down. There's more demand for borrowing, so we borrow more money, as well as we have cash from the Federal Reserve and increasing that supply. Both combined gives us more cash to spend, and we spend more. That makes that increases our consumption. So what is that in relation to expansionary and contractionary monetary policy? An expansionary monetary policy, again, is as the economy is going into that recessionary period, what the Federal Reserve can do, independent of the federal government, the Federal Reserve can decide on monetary policy to help maintain that level, a level of economic growth, or shore up. They can also put on the accelerator in the for the movement of the economy. They have an accelerator and brake as well as the Federal Reserve. As well as the federal government, and Congress has that accelerator and brake. So the accelerator, expansionary policy, is one, they can lower interest rates, increase borrowing, decrease saving. Both will be increasing spending for consumers and businesses. Two, they can reduce the required reserve ratio, which is the percent of money that banks must hold in their vault, that vault limit. Reducing that percentage increases the amount of money that banks have available to lend. So they lend more, interest rates go down. That's another increase. Interest rates going down, more money available, we borrow more money. We save less. And three, they can do an open market purchase. In an open market purchase, we put cash into, and increase the money supply by buying, the Federal Reserve buying bonds and exchanging it for cash. That cash increases the money supply increases interest rates going down, encouraging more borrowing and discouraging more savings. That encourages more spending. Those are expansionary. Now, contractionary is the opposite. The Federal Reserve increases interest rates, increases the required reserve, and initiates open market sales. Not purchases, but sales, which is selling bonds versus buying bonds. Now, let's focus a little bit about how this required reserve really grows the money supply. How does it do that? Well, I have $1,000 and I put it in the bank. And the required reserve is 20%. Let's just do that. And here's a chart of what happens all the way through when I do that. If I take my $1,000, what the bank is going to be able to hold is 200 of that. That leaves 800 available for loans. What if one person borrows $800 of that one person and takes that money, instead of spending it, saves it and puts it in the bank? That bank now has $160, not 200, but $160 that it has to hold, and it's going to spend $640 it can loan out, and so on. You can see that here's each person saving, putting money into the bank, their deposits, individual deposits, and here is the amount that is held by the bank, and here's what the bank is able to lend out. And you see how, if we add all this up, that $1,000 has increased to $5,000. It's that multiplier. And that multiplier is the reciprocal of the required reserve percent. So if we take that percent and convert it into a decimal, that becomes 0.2. 0.2 is the same as 1/5. Take the reciprocal of that. 1 over 0.2 is equal to 5. 5 times the amount of the original deposit of $1,000 gives us $5,000. Now, so we've grown, that $1,000 cycled through the entire, has increased the money supply from the $1,000, the money supply has increased to $5,000. That $5,000, what if we reduce, and I can easily do that right here, I've changed it now, it's 10% versus 20%. Now, you see that the numbers have changed. That $1,000 has grown to $10,000. 1 over 0.1, or 1 over 1/10, is 10. So 10 times. So we multiply that 1,000 by 10, and the money supply has grown with that $1,000 deposit, and a required reserve of 10% has increased to $10,000. You see that by reducing the required reserve, we've increased the money supply 10 times by just dropping it by 10%. And that's how that's called the required reserve money multiplier.